So let's finish our discussion of debt and taxes um, by just asking some questions. I guess a very important question is, so what? So what does this tell us, right? Do firms do firms prefer debt, right? If companies are raising capital from investors, they usually do that by issuing debt. They don't typically want to issue stocks. There's a lot of reasons for that. We'll talk about that a little bit more in another video. But they're really looking at um, issuing debt more than issuing stock. But that doesn't mean that the amount of debt is increasing. As you can see here, capital expenditures over the last couple of decades have steadily increased, while the net external funds has gone down. So what that kind of tells us is that companies are using something else besides debt and equity. Well, what else is there? Most companies prefer to use internal funds rather than external funds. And certainly this should make sense. Companies would rather use profits, something that they already have in their possession, than to go out and spend the money to find external dollars from the public. And if you can look at this, essentially you find that the debt to value ratio is declining over the last 3 or 4 years. Certainly it has with both just United States non-financials and the S&P 500 companies. So it's been fairly steady. When you look, it's mostly be between 30 and maybe let's say 35 or so percent and 45. But as recently we've seen it start to dip down a little bit, even below 30%. So again, the question is, do companies prefer debt? And the answer, I think, in the end, is a little more involved, right? It's a little bit more of a complicated question, and the industry you belong in answers a great deal of these questions. And if you could just look graphically without worrying about the individual industries, you can see that depending on the industry, there is a great deal of difference between net debt and total debt, right? So if you look here, how much debt does the company have? Biotechnology, some of these semiconductors, right? The healthcare technology, some of these, have relatively low amounts of debt. And then there are some up here that have huge amounts of debt. So we see that there are differences across the industry as to how much debt a company can have. Another question that might limit the amount of debt a company has is just limitations on the company. And the primary limitation that we'd be talking about is can you take advantage of the tax structure or the tax shield? So if you don't have income, you cannot take advantage of the tax shield. So on this a slide that we've been talking about, a company that has no leverage gets no tax benefit. A company that has high leverage saves some taxes. But if you have excess leverage, that is more than what you can pay for with having operating profit to cover the interest, then you also get no tax benefit from it. In fact, it ultimately might turn out to be a tax disadvantage at the investor level, because the investors are still going to be paying taxes on this income. So if a company is not paying taxes, right, that is T sub C equals 0, our ultimate tax shield then, T sub E minus T sub I, well, we already know that T sub E, the current tax rate on equity, is less than the tax rate on debt. So now this number is less than 0. So that means that in reality we have a tax disadvantage if a company has no profitable income to offset the tax shield. So the optimal level of leverage from a tax savings is that amount so that interest equals EBIT, right? So at this optimal level of leverage, the firm shields all of its taxable income. It doesn't have to pay any tax disadvantages. However, it's very difficult to predict this. So there may be years that we take advantage of the tax shield, and there may be years that it is a disadvantage to us. So in general, a firm's interest expense approaches its taxable earnings, but we also have some limitations on the amount of debt the company is actually going to use, right? So there are some limits, right? There are limits to this tax shield. Primarily, the limit we've been talking about is the ability to write off interest and maintain some profitable income for the tax shield to take effect. So how growth fits into this is we need to understand how to avoid this excess interest. So if the interest is less than EBIT divided by the current tax code, then that would be the amount of interest maximum that we would want to take advantage of this tax shield, right? So the higher the growth rate of the company, the higher the value of equity. So as a result, this proportion of debt in the capital structure will be lower, and that will be lower the greater the firm's growth rate. So the more growth we have, the less amount of debt we ultimately may want to have. In fact, that might be that we ultimately also want to try to finance most of this debt with profits rather than external shields or external types of financing. So there's lots of other tax shields that we can talk about, right? I guess the question in the end is, how are companies approaching this debt question? And when we look at this next slide, one of the things I think you'll see is that given the graphs that we've had so far, it would imply that companies should have a huge amount of debt. At the very least, they need to have enough debt to cover their EBIT, so they would be maxing their amount of debt to that point. But it turns out that companies in general have a relatively low amounts of debt. So why are companies borrowing at such lower amounts relative to what these videos have been talking about to maximize the value of the company? So what we find out is there's actually just something missing. We haven't been talking about something that's very important, right? Maximizing the amount of debt a company has is really, it doesn't make even any intuitive sense, right? Because of the costs of bankruptcy and financial distress. So while we understand that there is a tax shield and that adds benefit, and we have to be wary of not moving into a range where we have some tax disadvantages, we do understand that there must be another video to talk about to understand a little bit more about the more complete picture. And that is where we're going in the next chapter.